Welcome, class. We're on to chapter 12, titled Riskier Mutual Funds. So, again, last chapter, we would have talked a little bit about the safer side of mutual funds, money market, and fixed income products. We're going to be moving on now in chapter 12, talking about riskier mutual funds. So, what are riskier mutual fund products? These funds are designed primarily for capital growth and often accept higher risk in pursuit of higher returns. Unlike conservative mutual funds, such as money market and bond funds, these funds prioritize capital gains, or otherwise known as growth, over preservation or income. They tend to hold equities or specialized assets, and they have higher market risk and sometimes unique risk in comparison to more conservative funds like money market and bond funds. So, one example would be what we would call equity mutual funds. What are equity mutual funds? They are funds that invest primarily in stocks. Again, we've talked earlier in previous chapters that we can interchange the word stocks and equities. So, you could consider equity mutual funds stock mutual funds. The objective of equity mutual funds is for long term capital growth with some potential for dividend income, but it varies by different subsections of equity mutual funds. You might have dividend equity mutual funds, which then again is a subsection that would focus primarily on the dividend income. But we're talking in a general sense, equity or stock mutual funds, they would invest primarily to grow. What are the risks of equity mutual funds? Obviously, price risk, market risk, meaning price volatility. When you invest in stocks or equities, the price is constantly moving and changing throughout the day, throughout weeks, months, and years. There's also manager risk. If it is an actively managed mutual fund or equity fund, you could have additional risk added that a manager might make a poor decision on buying and selling of specific stocks or equities within the mutual fund. Some of the different categories of equity funds. So, again, subsections within the broad discussion of equity funds. You might have a standard equity fund, which is basically, like it says, general equity fund for growth and potentially some income. You could have an equity growth fund. Typically, when you see the word growth within the description of a fund, it's going to focus on smaller and or growing companies that have a higher risk, but also with that, a higher reward. And also within the equity fund category, you could hear the term or see the term index fund. What that means is that is a passive equity fund that simply tracks a benchmark. A benchmark, something similar to what we would call the S&P TSX. So a benchmark is simply just the broad market itself. So the TSX is the Canadian market. So a passive equity index fund might simply track what the Canadian stock market is doing. It is doing what like the TSX is doing. So not an active manager, but simply just tracking the overall index itself. And we'll go into a little more detail at a later date on that one. So again, we touched on this a little bit. Equity growth funds, also considered small cap funds. Anytime you will see the word growth inside the description of an equity fund, that means the focus of the stocks will be on smaller stocks, small cap. When we say small cap companies, we're typically talking about a company that's overall value is less than $1 billion. Typically, these types of firms reinvest profits for growth as they are smaller companies still in growth mode, trying to get bigger. They rarely pay dividends. So typically, a equity growth fund would not be used in order to create income because typically small cap companies don't pay out dividends. They simply reinvest profits into their own company in order to grow. These types of companies have a higher potential for return, but also come with a higher risk, a failure risk per se. So any small cap or growth oriented company, they typically are not long, don't typically have a long history of growth, a long-term history of profitability. They might be something like a new tech stock that has a new product or a new technology that they're trying to implement or get out or sell into the market. So huge potential, but also with larger potential comes higher risk that the company won't actually be successful and may actually fail. These also can be known or considered an aggressive fund or a special fund, special equity fund, due to the fact that its focus is solely on growth, capital gains, and focuses on investing in companies that have a higher potential for significant growth, but along with that, much more potential to fail. Equity index fund. Again, we mentioned it earlier. It's a passive strategy, meaning that there is no manager making daily decisions on whether or not we should buy or sell specific stocks. It is simply replicating the performance of an index. The example I used earlier, using the TSX, the Canadian stock market. A passive Canadian equity index fund would simply mirror or mimic or replicate the overall Canadian TSX market. No one making decisions of how or what to buy or sell. We're simply copying it. So no manager actively selecting the stocks. There is only market risk, no manager risk, because again, no manager is making decisions on specific stocks. They are simply buying exactly what the index is. Again, the objective of such an investment is simple long-term capital growth. Typically with a passive strategy, an index fund, you will see lower costs. MERs, again, we talked about earlier, being management expense ratios. If you don't have a manager having to look over research and make decisions, you're simply copying something, you're going to be able to have lower cost. So an index or a passive mutual fund will typically be less cost than an actively managed fund. Now we're going to talk a little bit about ETFs a little further in chapter 13. And please, if you could, you can either stop the video or look at the YouTube link that I've attached on the screen. I will link it outside of this presentation so that you can look at it. It goes into a little more detail about passive or index investing. Balanced funds. So balanced funds means you will have one investment, one mutual fund that will have both conservative investments within it and more aggressive investments within it. You will have stocks on the one hand that are the aggressive growth portion, and you will have fixed income, things like government bonds or corporate bonds, to offer income, interest, and stability. So balanced meaning a little bit of both growth and both safety and income. So again, the objective is to combine capital preservation and income and growth. Kind of a little bit of a piece of everything. A method, again, of owning a balanced fund can be a method of even being further diversified by simply having one investment. The word balanced fund is sometimes interchanged with asset allocation fund. They basically mean the same thing. Asset allocation has to do with how much of an investment you have in growth like stocks and how much you have invested in safety and income like bonds. So the two words mean the same thing. If you see on a test or an exam, a balanced fund, we are talking about a single mutual fund that has both growth safety, and income, bonds, fixed income, and stocks. If you see the word asset allocation fund, it means the exact same thing. What are the risks of investing with balanced funds? You've got a little bit of everything from a risk standpoint. You've got some market risk, some default risk, some interest rate risk, and some manager and manager timing risk. Because within a balanced fund, you have a little bit of a piece of all the other types of investments, means you kind of have a little bit of all of the risk. But having more types of risk doesn't mean it's more risky. You'll actually have smaller portions of each of these types of risks within a balanced fund because you have little pieces all over. Target date funds. This target date funds can also be the word can be replaced with life cycle fund or glide path fund. But these target date funds are investments or mutual funds specifically geared towards a specific date in time. So, for example, someone who is going to retire in 2050, or someone that is going to go to school, a child that's going to go to school in 2030. Again, these target date funds will have a specific date where the investment will gradually shift from being more growth oriented to all fixed income or all income safety at a specific date and time. So if you, for example, have a target date fund 2050 and it's currently 2025, we've still got 25 years until the date is coming up. It's a long time frame. So currently that target date fund would hold predominantly or almost all equities or stocks. Because in the early years, when you have a longer time frame, these target date funds will be more growth and riskier. As you get closer and closer to what that target date is, my example being 2050, you would be shifting into less stock and more bonds and fixed income so that at the target date, it may be 100% bonds and fixed income. So again, going from more risk oriented gradually to more safety and income so that when the funds are required, the majority of the risk is no longer in the portfolio. My experience is that typically these target date funds are fantastic for education. If we pick a target date for when each of their children, a family's children might be going to post-secondary education, we would pick that date as the target fund. And as the children are young, these investments are more growth oriented. As we get closer and closer to where the kids might need the funds for schooling, it becomes safer and safer so that there's far less volatility and risk in the portfolio. Global and international funds. Although these two terms seem the same, they are slightly different. They have the same objective where it will be growth and or income depending on the specifics of the fund, but it's geographically diversified. The biggest difference you have to remember between a global fund and an international fund is that a global fund will exclude, or a global fund will include Canada, an international fund will exclude Canada. Let's say that again. So if you see the Bank of Montreal Global Equity Fund, it will invest primarily in stocks that are throughout the world, including stocks from Canada. If you see the TD International Equity Fund, that fund would invest throughout the world in predominantly stocks, but will not include Canadian stocks. So again, global and international being a way to diversify outside of just one area, global including Canada though, and international excluding Canada. Some of the risks to these types of funds would be currency risk. As you're dealing with currencies that are outside of our home country, there is going to be additional risk that those currency values might either increase or decrease in comparison to the Canadian dollar. So that's an additional risk. There's foreign market risk. How much regulation, how much liquidity is there in the Chinese stock market versus Canada and US? So you're adding additional foreign market risk on top of just your home country. Um, there is the ability to hedge within these funds, specifically with currency, so that it can take away the risk that is added from having investments in different currencies. Again, what would happen is the fund manager might use forward and future contracts for currency in these other countries' currencies so that it makes no difference or it negates any changes in value comparing the Canadian dollar to these foreign currencies. There is always a cost to that. So typically, if a fund manager decides to hedge against currency, it would take away from the ability for growth from the mutual fund. Again, not all of it, just simply there is a cost to hedging. So it would take away slightly from the returns that could be possible on these types of funds if they decide to do it. Specialty funds, a bit of a broad term, kind of a catch all for anything that doesn't fall into the other types of mutual funds. They invest potentially, say, in one sector or one asset class. Examples might be a gold mutual fund or a biotech mutual fund or an energy mutual fund. Again, very specific, not broad in general and not as diversified, fairly specific. It allows us potentially to add one industry or one product, one type of investment to a client's portfolio and still use a mutual fund. Again, typically low diversification within these because they're very focused. And I would say a higher unique risk to it. Again, if you have one single sector, like the energy sector, and that's your entire mutual fund, well, you're not very diversified. You may not be diversified by different companies or different areas. You're very focused. So if that one industry gets hard hit, that mutual fund is also going to be declining fairly rapidly. The objectives of these specialty funds, often aggressive capital growth. They are really looking to shoot out the moon. So again, from a ranking standpoint, specialty funds would be the highest of risk, simply looking for capital growth. There is high volatility and is not suitable for all investors. Again, this would be a way to add a piece to an overall client's holdings for maybe a special reason, like they have they really want to invest specifically in the energy sector because we live in Alberta and a lot of people want to do that, or they want to invest in gold because they're concerned of um, a recession coming. So it's just, again, a way to add to a portfolio using a specialty fund in specific instances in order to add, but does create some higher risk to portfolios by adding these. Fund wraps or fund of funds. So basically, what this is a one single mutual fund a client would hold, but the holdings of that mutual fund are other mutual funds. So, for example, you might have something like that is called the, TD managed balanced portfolio, and it is one single mutual fund, and within that TD managed balanced portfolio, they might hold the TD US Equity Fund, the TD Canadian Equity Fund, the TD Corporate Bond Fund, the TD Energy Fund. So again, it is a single mutual fund that instead of holding individual stocks and bonds would hold other mutual funds. So it's managed by multiple portfolio managers. If you think there might be a single manager managing the overall portfolio, but within that overall portfolio, you have other individual mutual funds that also each have their own portfolio manager. So it's typically multiple fund managers involved. Investors buy units of the fund wrap, the specific overall mutual fund, not the underlying fund. Some advantages: there's diversification across styles and managers. It's a turnkey solution for investors to be able to invest in one single solution, yet hold multiple solutions. Some disadvantages: they may involve layered fees. They might have additional fees over and above one single mutual fund. And you could consider it having less transparency because you may not know exactly the holdings within the funds because, again, you have a single fund holding other mutual funds. One of the concepts from this chapter is market capitalization, specifically in the context of equity funds. It's kind of useful for understanding fund holdings and the risk and return potential for things. So, what is the definition of market capitalization? Market cap is the value of a company that is traded on the stock market, calculated by multiplying the total number of shares by the present share price. And again, quite simply, it is the overall value of a company or stock. So, three different categories of market cap when we're talking about this topic or this textbook. Small cap, when you see that term, when we're talking about companies or we're talking about mutual funds, typically we'll be investing in companies that have a market capitalization of less than $1 billion. An example they've used here is Wajax. A mid-cap company would be any company having a overall market capitalization or value between 1 and 5 billion. Companies similar to Cineplex, the movie company. And then large cap, when you see that, we are talking about companies or stocks that have a valuation or a market capitalization of greater than 5 billion. All the Canadian banks would fit that: TD Bank, BMO, RBC. So again, you may see that term discussed specifically in a equity mutual fund. You might see the TD small cap equity mutual fund. You might see the RBC mid cap equity mutual fund. And then you might see the Scotiabank large cap equity mutual fund. It's a good way to try to get a quick glimpse or understanding of what the underlying holdings are within a mutual fund, and along with that, how much risk and potentially reward. Small cap investments, again, being the highest of risk from a stock perspective. They are typically smaller growing companies, but have the biggest potential for growth. Mid cap, again, kind of that medium risk relative to each other. Larger companies, but still not extremely giant. Then you've got the large cap, which longer term, more stable, typically less opportunity for significant growth, but a lot of the times the larger cap tend to pay out dividends. So again, from a risk standpoint, small cap is the highest risk along with the highest potential for reward. Mid cap being the middle and large cap being the lowest risk for an equity investment with the lowest potential for return as well, though. So, looking overall at the different subsections of mutual funds we've talked about and thinking about the risk and return, money market would be the lowest of the risk we've talked about. Again, money market being almost like a cash position, has the lowest risk but also the lowest return. If we think about return right now in a money market fund, you're probably looking at 1%, potentially less than 1% at the moment. The next lowest risk would be a mortgage mutual fund, still considered low risk, but also comes with low return. If you think about what a mortgage mutual fund is currently returning from a return standpoint, you might be returning anywhere between 1 to 3%. Next in line from a risk standpoint would be a bond mutual fund. So with bond mutual funds, we would consider that moderate risk with a low to moderate return possibility. Next, a balanced mutual fund. Again, when you see balanced, think of middle or medium because it has medium risk, moderate or medium return. Right in the middle. Balanced has some of the lower risk investments and some of the higher risk in equal amounts. A dividend fund would be the next, still considered medium risk, still considered moderate from a return perspective. Next, an equity mutual fund. We start to qualify that as being high risk, but with potential for high return. And then specialty mutual funds has the highest risk, but also the highest potential for return. So again, what did we learn? What are the key takeaways to get from this chapter? Be able to differentiate fund types by risk and objective and asset mix. So, for example, an exam question might list what the risk and objective and asset mix might look like in a specific mutual fund. You need to be able to pick from the list of fund names which one it associates to. Know which funds carry market risk, unique risk, currency, and foreign market risk. You need to be able to understand what a fund wrap structure is, a fund to fund. Memorize how target date funds shift over time. And you need to be able to recognize how index funds differ from actively managed equity funds. As always, this is simply a review of the chapter. Please read the chapter word for word. Please know that on the final exam, the entire chapter is testable. And we will see you next week. Also, don't forget there will be a YouTube link or two included in this chapter, so please view those. Bye for now.